For the next topic included in this module is about the legal system and pricing. Okay, so here, normally, there are some interventions of the government related to the pricing policies of the business enterprises. So that's why if you notice, in some cases, like for example, in this time of pandemic, DTI actually regulates the pricing of some essential goods, okay, and services, so that consumers will be able to still afford, okay, to purchase those goods and services, given the condition that most of the people are having problems, especially in employment. So here, predatory pricing is the practice of setting prices below cost for the purpose of inuring competitors and eliminating competition. So aside from the government's intervention, there are actually some of the enterprises that they sell their products even below its cost, meaning to say this is the same as that of the cutthroat competition, in which these companies are offering much lower prices compared to their competitors, get the extent of losing actually are not acceptable, or that is prohibited. Okay, so of course this is for the benefit of the other players in the market. So another is price discrimination. So this refers to the charging of different prices to different customers for essentially the same product. So again, we have the suggested retail prices for all the goods and services. So it must be followed, or they can all have a small markup, but not too high or too low from that of the SRP. Okay, so again, price discrimination is basically not acceptable. Okay, so to illustrate, we have here for Cobalt Incorporated. So they manufactures vitamin supplements. So with an average manufacturing cost of $163 per case. So each case contains 100 bottles of vitamins. So the company sold 250,000 cases last year. So to the following three classes of customers. So they sell their products to the large drugstore chains, small local pharmacies, and individual health clubs for the following price and the number of cases sold last year. Okay, so here the large drugstore chain special labeling costs $0.03 per bottle. So the chain orders through their electronic data interchange. So that costs the company about $50,000 annually in operating expenses and plus the depreciation. So the company pays all the shipping costs for the orders that amounts to $1.5 million last year. Okay, so the small local pharmacies, on the other hand, they order in smaller lots that require special picking and packing in the factory. So the special handling will add $20 to the cost of each case sold. So sales commissions to the independent jobbers who sell the products to the pharmacies average 10% of the sales. They also have bad debt expense that is 1% of the sales. So for the individual health clubs, they purchase vitamins in even smaller lots. So the special picking and packing cost average $30 per case. So there are no sales commission. Instead, the company advertised it in health club management magazines. So they accept orders by phone and supplies point of sale posters and display for the clubs. So these marketing costs are $100,000 per year. So they also have bad debt expense that average 10%. Okay, so for the requirement, so calculate the total cost per case for each of the three customer classes. Second, using the cost from requirement number 1, we have to calculate the profit per case per customer class. So does the cost analysis support the charging of different prices? So this is price discrimination. Why or why not? So what if Cobalt charge the average price per case to all customers classes? How would that affect the profit percentage? So this is an example of, or this illustration is an example of price discrimination because they charge different uh, prices depending on the classes of their customers. Okay, for the first requirements, our solution is the total cost per case is $178.4. So that's for a total cost per case for each of the three. Okay, so here we just added all the this is for the chain store. So chain store is the total cost per case is $178.4. For the small pharmacies, the total cost is $208.52. For the health club, it's $222. So if you could notice, their cost per class actually changed because there are special handling and uh, packing and picking that adds up to the normal cost of producing or selling smaller lots. Okay, so that's why this is actually the reason why they charge differently to the different classes of their customers. So if you could notice, individual health clubs normally has the higher price because if we will base also that on the total cost per case, health clubs as well has the largest cost among the three classes of customers. Okay. So for the second requirement, so using the cost in requirement number 1, we will calculate the profit per customer. So we will determine, does the cost analysis support the charging of different prices? Okay, so here our profit per case for chain store is 21.60. For small pharmacies, that's 23.4. And for health club, that's $28. Okay, so you also notice that the profit percentage also increased because again, our cost is higher for those small pharmacies and health clubs because there are added costs for picking and packing. Okay, so this justifies their a different charging of prices. So for requirement number 3, what if the company charge the average price per case for all their customers? So if we will average their price, so per case, that is 227. So you just add and divide it by 3. If this price were charged to all 3 customers, the profit percentage for the chain store would increase and the profit percentage to small pharmacies and health clubs, of course, will decrease. Okay, because of the higher cost. So while the company would earn the same overall profit percentage, this assumes that the chain store would continue purchasing the vitamins from the company at the new higher price. So this assumption may be wrong. The chain store may well refuse to buy any product from the company, leaving the company with fewer units sold overall and lower profit from the remaining customers. Because in this case, okay, just to cope up with the cost. So if they will charge the average price, so again, the company should what do you call this charge the price, the selling price that should be above its cost. So again, the effect of this might be that they may charge much higher prices, and the effect will be their customers will look for another supplier who are offering a lower price. Okay, so that's the danger of providing average price per case for all their customer classes. So again, based on their existing policy, I guess it's justifiable because we have seen that the product or the cost are actually higher with small lot that is sold for these small pharmacies and health clubs. Okay, so that's how they justify that their pricing of the different on the different classes of their customer is not actually price discrimination. Okay. So next is measuring the profit. Okay, for this one, of course, this is one of the important uh, information that each owner and every enterprise wanted to know. Okay, so their profit. So here, firms are interested in measuring profit. That's why we actually prepare income statement. Okay, and they are classified according to whether or not profits are uh, their primary objectives. They are either for profit or for not for profit entities. Meaning to say, the importance of determining the profit is not only for the profit organizations, even not for profit organizations are actually computing or determining their profit if there is. Okay, although they are not after the distribution, but they are also looking into the return on that profit to their organization to be used for expansion and other things that they need, okay, within their within the entity or the organization. So this includes the viability of the firm, measuring managerial performance. So we can also see that in the profit measure. Okay, determining whether or not a firm adheres to the government regulations, and signaling the market about the opportunities for others. So these are some of the reasons why it is very important, okay, to measure the profit. Okay, so in our introduction earlier, we've mentioned about two approaches on measuring the profit. This is the absorption costing, and the other one will be discussed in the later part. But in this module, we have two major measuring profit of the profit approaches. So the first one is absorption costing approach. Okay, so when we say absorption costing, it's another term is full costing. Actually, this is required for external financial reporting. According to GAAP, profit is a long-run concept and depends on the difference between your revenues and expenses. This is actually the acceptable approach if we will report it outside of our organization. Absorption costing or full costing is our usual income statement or traditional income statement that we are preparing. So over the long run, all costs are variable. Okay, but of course, we also consider the fixed costs as well, okay, as part of the expenses. So therefore, fixed costs are treated as if they were variable by assigning some to each unit of production. So that's what we have mentioned earlier. Absorption costing assigns all manufacturing costs, direct materials, direct labor, variable overhead, and a share of fixed overhead to each unit of product. So each unit of product will absorb some of the fixed manufacturing overhead in addition to our variable manufacturing costs. So when a unit of product is finished, it takes this cost into inventory, okay, while they are still in stock. But if they are sold, then they will be part of our cost of goods sold. So yeah, okay. When it is sold, these manufacturing costs are shown in the income statement as cost of goods sold. So it is absorption costing that is used to calculate three measures. So here we will see your gross profit measure, operating profit, and your net income. Okay, to illustrate absorption costing approach to measuring profit, we will use Laser Save Incorporated. So here, the company is a recycler of used toner cartridges for laser printers. So they began operations in August and manufactured 1,000 cartridges during the month with the following unit costs. So fixed factory overhead is $20,000 per month. During August, 1,000 cartridges were sold at a price of $60, and fixed marketing and administrative expense were $12,000. Okay, for our requirement, number one, we have to calculate the unit cost of each toner using absorption costing. Second, how many units would remain in ending inventory? What is the cost of ending inventory using absorption costing? Third, we will prepare an absorption costing income statement for the company for the month of August. And number four, what if September production was 1,250 units, costs were stable, and sales were still 1,000 units? What is the cost of our inventory, ending inventory? What is the operating income for the month of September? Okay, for the solution, so the unit product or manufacturing cost under absorption costing is, again, if you could notice, we included the fixed overhead. So again, this is the traditional uh, costing, okay, that we have. So this, by the way, this cost were actually multiplied to the number of units that is produced. Okay. So next is, by the way, number one is per unit. So not necessarily multiplied with the number of units produced per unit. Okay. So number two, after determining the total cost per unit of production, so how the second requirement is how many units remain in our ending inventory. Okay, so of course this is familiar. This is a familiar formula to you. So units in ending inventory is equal to our beginning inventory plus the units produced minus those that we have sold. So in our example, there is no provision as to the beginning inventory. Okay, so the big units produced during the year is during the month, I mean, is 1,000, and we also sold 1,000 during the month. So therefore, we have no ending inventory, and there is also no cost of ending inventory. Okay, for the third requirement, so we will prepare cost or absorption costing income statement. Okay, so this is the common or the traditional income statement that you are actually preparing. Okay, so sales less cost of goods sold is equal to our gross profit. So here we will less variable marketing, or these are non-manufacturing costs, okay, or expenses. And our operating income is $3,750. Okay, so requirement number four, what if on the next month of September, the production was 1,250 units? Okay, so what is the cost of ending inventory and what is the operating income for the month of September? So here, first we will determine the ending inventory. Okay, so we do not have beginning inventory still because in the month of August, there is no ending inventory left. Okay, that will be forwarded in the next month. So 0. For our units produced, that's 1,250 units. Okay, and then we sold only 1,000 units. So there is an ending inventory of 250 units. For the cost of ending inventory, okay, so we have here, if you could notice, this is our fixed manufacturing cost is divided by the number of units manufactured. So per unit is $16, and then we will just add the other costs to it. That's why it's now equal to $39. So all you have to do is just multiply it with the ending inventory in units. So therefore, the cost of ending inventory is 9,750. So for the new operating income, so the same format, sales less cost of goods sold, okay, is equal to gross profit less the non-manufacturing expenses. So our operating income is higher, okay, to 7,750. Of course, because in this case, what happened, if you will compare it with number 3, so our cost of goods sold per unit has decreased. Okay, that's why the effect of that is our operating income increased. So that's for the absorption costing approach to measuring the profit. Again, this type of uh, approach is the usual approach that you have learned, okay, in the traditional preparation of your income statement for measuring profit. Okay, so the second one is variable costing approach to measuring profit. This is the second approach. Okay, for this type, variable costing, sometimes this is called as direct costing. So it assigns only unit level variable manufacturing cost to the product. So these costs include direct materials, direct labor, and variable overhead, which are inventory. So when we say variable costing or direct costing, this is your contribution margin approach. Okay, so in which we only include inventoriable expense, those which are variable expenses, and the fixed expense are expense when incurred. Okay, so fixed overhead is treated as a period cost, and this is not inventory with the other product costs. So this is expense in the period as mentioned when it is incurred. The reason for this is to reduce the factory costs that are inventoriable, and that in this concept also uh, we are actually assuming that fixed costs do not change, or it has no direct influence or relationship with the number or level of production and sales. That's why it's not inventory. Okay, to illustrate, again, we will use the same company and the same data provided. Okay, so the same requirement. Okay, as in the absorption or full costing approach. So what happened? Okay, for our unit product cost under absorption costing, so our total cost is much lower because in this case we did not include the fixed overhead. Okay, for the units and ending inventory, the same also, because we do not have inventories left at the end of the month. Okay, for our income statement, so here sales minus your variable costs. So again, this is contribution margin approach format. Okay, and we will less at the end your fixed overhead and marketing and administrative expenses to determine operating income. Okay, and what about for requirement number 2? So here uh the same unit at the ending inventory of 250. However, our cost of inventory is just 23 as determined in the first requirement. Okay, and then the new operating income is now what happened? Okay, in the previous month we have $3,750. Okay, the same. Okay, we have the same operating income. Okay, because in this case, we also sold the same number of units at 1,000 units. Okay. So those are for our two approaches in measuring profit.